Hello everyone and welcome to my channel, where I share tips and tricks on how to make money online and offline. In today's video, I'm going to show you 5 fast ways to make money during the 2024 recession. Yes, you heard me right, the 2024 recession. You might be wondering, what recession? Well, according to JP Morgan research, there is a 25% chance of a recession by the first half of 2024, 45% by the second half of 2024, and 60% by the first half of 2025. The main reasons for this are stubborn inflation, higher interest rates, slower growth, geopolitical risks, and shrinking liquidity. Sounds scary, right? But don't worry, because there are still ways to make money even when the economy is struggling. In fact, some of the most successful investors and entrepreneurs have made their fortunes during recessions. For example, Warren Buffett, the legendary investor and one of the richest people in the world, has been known to buy undervalued stocks and businesses during downturns and sell them for huge profits later. He once said, "Be fearful when others are greedy and be greedy when others are fearful." So, how can you apply this mindset and make money fast in 2024? Well, I'm going to share with you 5 strategies that are based on Warren Buffett's principles of value investing, long-term vision, diversification, investing in stable industries, and patience. These strategies are not only effective, but also easy to implement, even if you have little or no experience in investing or business. All you need is a smartphone, a laptop, and an internet connection. Are you ready? Let's get started. Number 1. Value investing. The first strategy is value investing, which means buying assets that are trading below their intrinsic value. In other words, you want to find bargains that are overlooked or ignored by the market. This could be stocks, bonds, real estate, commodities, cryptocurrencies, or anything else that has a price and a value. The key to value investing is to do your own research and analysis, and not to follow the crowd or the hype. You want to look for assets that have strong fundamentals, such as earnings, cash flow, assets, competitive advantage, growth potential, etc. You also want to look for assets that have a margin of safety, which means that they are priced significantly lower than their true worth. This way, you can reduce your risk and increase your reward. One of the easiest ways to find value assets is to use online tools and platforms that provide data and ratings on various markets and sectors. For example, you can use Yahoo Finance, Morningstar, StockRover, Finviz, Zillow, CoinMarketCap, etc. to get information and insights on stocks, real estate, cryptocurrencies, and more. You can also use websites like Value Investors Club, Guru Focus, Seeking Alpha, etc. to get ideas and opinions from other value investors. However, you should always do your own due diligence and verify the information and sources that you use. Don't blindly trust anyone or anything, especially on the internet. Remember, the goal of value investing is to think for yourself and find your own opportunities. Number 2. Long-term vision. The second strategy is to have a long-term vision, which means investing for the future, not for the present. This means that you should not be swayed by short-term fluctuations, emotions, news, rumors, etc. Instead, you should focus on the long-term prospects and potential of the assets that you invest in. You should also be prepared to hold your investments for years, if not decades, and not sell them at the first sign of trouble. The benefit of having a long-term vision is that you can take advantage of compound interest, which is the process of earning interest on your interest. This can make a huge difference in your returns over time. For example, if you invest $10,000 in an asset that grows at 10% per year, you will have $25,937 in 10 years, $67,275 in 20 years, and $174,494 in 30 years. However, if you invest the same amount in an asset that grows at 15% per year, you will have $40,456 in 10 years, $163,665 in 20 years, and $662,118 in 30 years. That's almost 4 times more. Another benefit of having a long-term vision is that you can avoid paying taxes on your gains until you sell your investments. This can also boost your returns significantly, especially if you use tax-advantaged accounts like IRAs, 401(k)s, Roth IRAs, etc. These accounts allow you to defer or eliminate taxes on your investments, depending on the type and rules of the account. For example, if you use a Roth IRA, you can invest up to $6,000 per year or $7,000 if you're 50 or older, and withdraw your money tax-free after you reach 59 and a half years old. This means that you can grow your money without paying any taxes on it, ever. Number 3. Diversification. The third strategy is to diversify your portfolio, which means spreading your money across different types of assets, sectors, markets, countries, etc. This way, you can reduce your risk and increase your chances of making money. You don't want to put all your eggs in one basket, because if that basket breaks, you lose everything. Instead, you want to have multiple baskets, so that if one of them breaks, you still have others to rely on. The key to diversification is to have a balanced and well-rounded portfolio that reflects your goals, risk tolerance, time horizon, etc. You don't want to have too many or too few assets, or too much or too little exposure to certain areas. You want to have a mix of assets that complement each other and perform well in different scenarios. For example, you might want to have some stocks, bonds, real estate, commodities, cryptocurrencies, etc. in your portfolio. You might also want to have some assets that are more stable and conservative, and some that are more volatile and aggressive. You might also want to have some assets that are more domestic and familiar, and some that are more foreign and exotic. One of the easiest ways to diversify your portfolio is to use exchange-traded funds, ETFs, which are collections of assets that trade like stocks on an exchange. ETFs allow you to invest in a variety of markets and sectors with just one purchase. For example, you can use ETFs to invest in the S&P 500, the Nasdaq 100, the Dow Jones Industrial Average, the Russell 2000, the MSCI World, the MSCI Emerging Markets, the Bloomberg Barclays Aggregate Bond, the S&P Gold Shares, the Bitcoin Trust, etc. You can also use ETFs to invest in specific industries, themes, strategies, etc. such as technology, healthcare, energy, consumer, value, growth, dividend, etc. However, you should be careful not to over-diversify your portfolio, as this can dilute your returns and increase your costs. You should also be aware of the fees, risks, and performance of the ETFs that you use. Not all ETFs are created equal, and some may have higher expenses, lower liquidity, tracking errors, etc. than others. You should always do your research and compare the ETFs that you are interested in before investing in them. Number 4. Investing in stable industries. The fourth strategy is to invest in stable industries, which are industries that provide essential goods and services that people need and use regardless of the economic conditions. These industries tend to be more resilient and profitable during recessions, as they have steady demand, loyal customers, strong cash flow, low debt, high margins, etc. Some examples of stable industries are utilities, consumer staples, healthcare, education, etc. The benefit of investing in stable industries is that you can generate consistent and reliable income from your investments, as these industries tend to pay regular and generous dividends to their shareholders. Dividends are payments that companies make to their owners from their profits, usually on a quarterly or annual basis. Dividends can provide you with a passive and recurring source of income, which can help you cover your expenses, reinvest in your portfolio, or save for your goals. Dividends can also help you reduce your risk and volatility, as they can cushion your losses and smooth your returns. One of the easiest ways to invest in stable industries is to use dividend ETFs, which are ETFs that focus on dividend-paying stocks. Dividend ETFs allow you to invest in a basket of high-quality and high-yield stocks from various stable industries with just one purchase. For example, you can use dividend ETFs to invest in the Vanguard Dividend Appreciation, the Vanguard High Dividend Yield, the iShares Select Dividend, the S&P Dividend, the Schwab US Dividend Equity, etc. You can also use dividend ETFs to invest in specific regions, such as the US, Europe, Asia, etc. However, you should be careful not to chase the highest dividend yields, as they may indicate that the company is in trouble and may cut or suspend its dividend in the future. You should also be aware of the tax implications of dividend income, as it may be subject to different rates and rules depending on the type and source of the dividend. You should always consult a tax professional before investing in dividend stocks or ETFs. Number 5. Patience. The fifth and final strategy is to have patience, which means waiting for the right time and opportunity to invest or sell your assets. This means that you should not be impulsive, greedy, fearful, or emotional when making your investment decisions. Instead, you should be rational, calm, confident, and disciplined. You should also have a plan and a goal for your investments and stick to them. The benefit of having patience is that you can avoid making costly mistakes, such as buying high and selling low, chasing fads and trends, overtrading, etc. You can also take advantage of market inefficiencies, such as mispricing, panic selling, euphoria buying, etc. You can also enjoy the process and the journey of investing, rather than stressing over the outcome and the results. One of the easiest ways to have patience is to use automation and automation tools, such as robo-advisors, apps, websites, etc. These tools can help you set up and manage your portfolio, execute your trades, rebalance your assets, etc. without requiring much of your time, effort, or attention. For example, you can use robo-advisors like Betterment, Wealthfront, Acorns, etc. to create and optimize your portfolio based on your goals, risk tolerance, time horizon, etc. You can also use apps like Robinhood, Stash, Cash App, etc. to buy and sell stocks, ETFs, cryptocurrencies, etc. with low or no fees. You can also use websites like Mint, Personal Capital, Quicken, etc. to track and monitor your finances, budget, net worth, etc. However, you should be careful not to rely too much on automation and automation tools, as they may have limitations, errors, biases, etc. that could affect your performance and experience. You should also be aware of the security and privacy risks of using these tools, as they may expose your personal and financial information to hackers, scammers, etc. You should always do your research and review the terms and conditions of the tools that you use before signing up for them. So, there you have it, 5 fast ways to make money during the 2024 recession. These are value investing, long-term vision, diversification, investing in stable industries, patience. These strategies are based on the principles of Warren Buffett, one of the most successful investors and entrepreneurs of all time. They are also easy to implement, even if you have little or no experience in investing or business. All you need is a smartphone, a laptop, and an internet connection. Of course, these are not the only ways to make money during a recession, and there are many other factors and variables that could affect your results and performance. You should always do your own research and analysis, and not take anything that I say as financial advice. You should also be prepared for the risks and challenges that come with investing in business, especially during a recession. You should only invest or spend what you can afford to lose, and never invest or spend more than you need or want. I hope you enjoyed this video and found it helpful and informative. I'll see you in the next video. Bye for now.